Good evening, students. Today we will discuss chapter 6 in your study pack, Investor Appraisal Techniques. Then we will move from there. I am sure like the previous courses, wherever you would have studied, similar or maybe the same or more than this or less than this scope of the syllabus on this area. So we will discuss what are techniques available for evaluating long-term projects. So the investment appraisals we are going to look at, it's about the long-term investment projects or long-term projects. So generally the investment projects have certain characteristics, right? If you look at, it will have a start point and end. So you will say you are starting from year 0 and it can be year 10, it's the end of the period. So you have 10-year projects or it can be 5-year, it's a long-term projects. And then resources are very clearly identified and then you allocate the resources to the projects. And there will be a clear plan in implementing the project throughout. In addition, you will see there will be a project team who will be entrusted with the task of ensuring the project milestones are achieved, and they regularly monitor what's happening in the projects. So there will be a project team involved in the project implementation. Further, the project generally cut across many functions of your company. So if your company has many functions or departments, every project what you think of in a long-term nature will cut across various functions. So you will see that cut across various functions of the company. So these are some of the characteristics you will see in the long-term investment projects. The purpose of a long-term project, if you really look at, it could be expanding your business, or it could be increasing your product lines, or it can be new markets. You want to get into new markets, new geographical markets you would like to go, and maybe a new business totally. It's not the product line you are involved in at the moment. Maybe new business totally you want to look at it. So it can be various things. It's all relevant to the expansion of your company. It can be new product lines, new market, new businesses. It can be any of these. Any of these could be relevant to the project. So what we would be looking at, how to evaluate these projects, because these projects are long-term nature. So we don't evaluate based on profit or loss. Most of the time. Since all are long-term nature, there are various techniques we would have learned in the previous stages or some other degree programs. You would have studied these investor appraisal techniques. So we quickly go through to understand what are these techniques and what other or new things you could be looking at in the final level for the exam purposes. So investor appraisal technique, if you take, it can be your accounting based ratios, that is accounting rate of return, which is generally your average profit. When I say profit, here it's mostly the EBIT, earning before interest and tax. It's average profit. If you have a 10-year project, what is your average profit of a year? Divided by average investment. So your investment at the beginning can be say 10 million. At the end of the project it can be 0 rupees. So your average investment can be 5 million. That is 10 million plus 0 divided by 2, it's 5 million average investment. Average profit is your 10-year projects, but you generate that divided by number of years, which gives you average profits. It's actually EBIT before the interest and tax we consider. So you could see that there is an example in the tute or the study pack. You can look at that. The study pack, I think the question, I think the number or the page number is 143, which basically say how to calculate the ARR. So it's not a very serious thing. It's just the average profit divided by average investment gives you ARR. So how do you evaluate? How do you evaluate? Now say example you cut the ARR for a project say 18% per annum. 18% per annum. You need to decide whether I should accept this project or not based on the ARR. So what you need is a target ARR. Your company should have a target ARR. If your target ARR is say 20%, target ARR is 20% per annum, you compare the target ARR of the project and the actual ARR of the project. Actually is 18% and your targeting is 20%. So your project should not be accepted. So please understand that in order to evaluate the project, you should know what is your expectation. What is your expectation or target ARR compared with the actual or the possible ARR you can get it from your project is 18%. So your project is not going to be accepted based on ARR technique. ARR technique has its plus and minus. If I say plus, generally it is easier to understand. Generally it is easier to understand because you can tell any person to say like, okay, this project can give you X amount or 18% return for your investment. So that is basically people understand, okay, this is my return I am going to get. Easier to understand. And comparatively easier to calculate also. Easier to calculate. It's not difficult to calculate. Easier to calculate also. So that's another advantage of the ARR technique. Disadvantage or minus of this ARR technique, this is basically on the accounting base. Accounting base when you say it is subject to your accounting policies what you are following. So company to company the policies can vary, then your accounting ratio also can vary. I think the previous when we discussed on ratio analysis, one of the limitations is your accounting policies. So ARR also falls onto the ratio. So definitely that has the same weakness of accounting basis. Then you will see that ARR technique does not look at your cash flows of the project, At the same time, it does not look at time value of money. So please note, cash flow or time value of money is not considered in ARR technique. So that's a key weakness or the disadvantage of the ARR technique. Even though it can be easily calculatable or it's easy to understand, but practically when you look at, it does not look at cash flow of the project, neither time value of money. So that's basically ARR technique. Then looking at the second technique, what you could be using for evaluating investment appraisal is the payback period. It's a payback period. So payback period is basically try to identify or calculate how long your project will take to recover the investment. So if you are investing say year 0 10,000 or 10 million and you say the year 1, 2, 3 your cash flows are 7,000 and 2,000 and 4,000. That means the third year, you are basically recovering your capital investment in year 0. So the third year you are recovering your 10,000. So what we can do is we calculate the year 1, year 2. So that means your 2 years plus number of months it will take to recover your 10,000 investment. So this is payback period. It gives you the time period, how long it takes to recover your investment. So this is payback period. The payback period is generally used as a initial screening technique because it will tell you how long it takes to recover your investment. So any investor would like to know how long I have to wait for to recover my capital. So it will say 2 years plus how many months or 5 years plus how many months. So that's one of the big or good thing about the payback period. It tells you how fast you can recover your capital. It has its pluses as well as minuses. What is a plus? As I mentioned, it shows the how long it takes to recover. So that's the knowledge you are going to get based on the project, how long I'm going to take. So that's an advantage for me to know whether it's a shorter period or longer period. And it looks at cash flow. Obviously the payback period looks at cash flow. It's not based on accounting calculation. It's purely on a cash flow. But it has minuses. What are minuses? The cash flows after payback period. If you say 2 years plus some months will be taking to recover your capital investment, payback period. Year 4, you have another 5,000 cash flows. If you have 5,000 cash flow in year 5, payback period does not look at that. Payback period is over by this. You are telling how many years recovery period, that's it. After that, whatever the cash flow you are going to have, which will not be considered in the payback period. So the disadvantage is cash flow after payback period not considered. The other minus, it also does not consider time value of money. So please note, payback period also like ARR does not look at time value of money. It's only the cash flow it looks at, not the time value of money. But it looks at cash flows compared to ARR. ARR does not look at cash flows, but payback period looks at cash flow. But even the cash flows after the payback period is not considered, and time value of money is not considered. So these are the plus minus of this. Actually, the payback period is used in organization to screen the projects to find out how long it takes. So most of the time, the companies have policy or the criteria where they will say, we would like to accept projects which will give payback period of say 5 years or less than 5 years. So when you get 10 projects to be evaluated for a company, larger company, you may get many projects. So you evaluate payback period or calculate payback period and say, okay, project A, B, C, D, and how long the payback period is. So any projects which are more than 5 years, you basically reject those projects because you don't want to take any projects which are very long term. So you take only projects which are less than 5 years and then take it as a initial screening method and see what are projects capable of accepting or acceptable for the company point of view. So that's the payback period you need to be aware of. Then moving on to the third technique. Whatever we looked at now, ARR and the payback period, please be aware, ARR and payback period, both of these techniques are non-discounting techniques, non-discounting cash flow techniques. That means you are not going to discount your cash flows, non-DCF technique we call it, or non-discounting cash flow techniques. These are techniques where you don't involve discounting process. There are other techniques which we will be taking one by one, that is NPV, IRR, discounted payback. So you can look at, or maybe even the profitability index, which is anyway deriving numbers. So these techniques are discounted cash flow techniques, or DCF techniques. So these are non-DCF techniques, these are DCF techniques. So please be clear that there are two types. One is non-discounting cash flow technique and discounting cash flow techniques. So under the discounted cash flow techniques, we'll look at first NPV technique. I'm sure all of us know what is NPV, that is net present value, which is your discounted values of cash inflows and outflows. So your company will have cash inflows, outflows year by year, and you discount using cost of capital, you discount using relevant cost of capital, and get present value. So you will get present values. The cash inflows and outflow present values are taken and you would calculate net of that, that is called net present value. So this is something you would have done many times in the previous stages, how to calculate NPV of a company. So that's not new thing for you, but the NPV when we calculate, we know that okay, we have to forecast or estimate the future cash flows. The cash flows can be inflows and outflows. All these cash inflows and outflows you will discount using a cost of capital. Generally the cost of capital is the required rate of return of the investors, required rate of return of the investors. So when you get the net present or the present values, it can be plus positive. If it is inflows, you have positive present value. If it is outflow, you have negative present value. Net of that is called NPV. Now, how do you decide whether your project is acceptable or not? So whatever the cash flow you have considered, you discount those cash flows and you get your NPV. So when you get your NPV can be, for example, say 10 million positive. 10 million positive. Now when you have 10 million positive, what do? Will you accept the project or reject the project? The primary objective of the company is to do what? Maximize the shareholders' wealth. So in order to maximize shareholder wealth, you need to create wealth. In order to maximize shareholder, you have to create wealth. So when you are going to accept new project, you being a company running for so many years, you are going to accept a new project. So when you are going to accept new project, that project should create wealth for the shareholders. So how do you see that wealth? It is your positive present value what you are generating from the project. So if I have 10 million positive NPV, which means I am creating wealth for my shareholders by 10 million. By this project, I am creating 10 million wealth for shareholder on top of what the wealth they have already. So by accepting this project, the shareholder wealth will go up by 10 million. 10 million wealth will go up in present value term. Today's term, the wealth will go up. So example, if your company's wealth today, say 100 million rupees before accepting the project. And you are going to accept a new project which is going to give you 10 million positive NPV. So what is going to happen to your total wealth of your shareholders? The 100 million wealth of the shareholders will go up by 10 million when you accept the project today. Not after 5 years, after 10 years or whatever the project period is ending, not that time period. Immediately after you accept the project, your wealth should go up to 110 million. So please be aware that the wealth is going up on year 0. So that is how the creation of wealth takes place based on the NPV of the projects. Whether it's exactly 10 million or slightly lower than 10 million depends on your company's track record, your management, credibility in the market, and your success rate of the past projects. All that will decide whether your NPV of the project will immediately convert into the wealth of the shareholders in the stock market. So therefore, you need to be aware that this can be sometimes lesser than 10 million, but your NPV is 10 million. So ideally, your wealth of the shareholder is going up by 10 million immediately after accepting the project. Immediately after accepting the project, not completing the project, accepting the project. But 10 million can be lower than, sometimes lower than 10 million. If the company past track record says whatever the project they have taken has not been very successful, so shareholders also might not accept 100% of the NPV as the value creation. They give us some percentage and discount and calculate it. So please be aware that this is the reasonable amount of wealth you can create if you are having a good track record when you accept the project of NPV 10 million. Then, so that means you are accepting the project. When you say 10 million positive, your NPV is 10 million positive, then you accept the project. Similarly, you say NPV of the project is minus 10 million. Minus 10 million. When you have minus 10 million, you will reject the project. Why? Because your shareholder wealth will go down by 10 million. You are destroying the wealth of the shareholders, so shareholder wealth will go down by 10 million, you don't accept the project. Then look at the NPV of the project is 0. If your project NPV is 0, what do you mean by that? It's actually breaking even in terms of time value of money. In time value of money, you are breaking even. Your cash flows, when you discount, you are getting an NPV of 0. Whether I should accept this project or reject this project. Now, when I say NPV is 0, my project or the project I am investing is giving a return or earning the return equal to expected return of investors. Please note, the project is earning return which is equal to expected return of the investors. So, if the expected return of the investor, which is generally the cost of capital equal to expected return, I think previously when we discussed previous session I explained that your expected return of the investor is equal to cost of capital. So, cost of capital only you take it for discounting of your project cash flow. So, expected return of the investor is, say for example, 15%. If your expected return of the investors is 15% per annum and you are earning return, that is your project is capable of earning a return, that return is also 15%. So, the project return or the project capacity to earn return of 15% and the investor's expected return is 15%. So, what is expected is earned by the project. If the project is earning or capable of earning 15% and the expected return is also 15%, you are basically earning what is required, If you are earning what is required, your NPV is 0. In other words, when your NPV is 0, that is the cost of capital and IRR of the project is equal. So, expected return is the cost of capital. IRR is the earning return or the project return. So, your project return and cost of capital both will be equal when your NPV is 0. So, please understand that when you have NPV 0, you are earning the return requirement of the investors. So, if you are earning the return requirement of investors, whether you should accept the project or reject the project. Here you have positive NPV, so definitely you have created wealth, you accept. You are 10 million minus, you are destroying wealth, reject the project. When you have 0 NPV, what's actually happening? You have earned the return requirement of the investors from the project. So, what you have earned is equal to what is expected. So, do you accept or not accept? The answer is accept. Why? What you want, you have got. So, you should not be worried about. Only thing, you don't create wealth, neither destroy wealth. But you have earned what is required. So, it's like an employee working in a company, he is expecting increment of 15%. And the company gives 15% increment. So, what happens? If you are given more than 15%, you are very happy. Because you are expecting 15 and the company gives you more than 15 and you are very happy. But if the company gives you 10% and you are expecting 15%, you are not happy. You are not going to be motivated. You think, okay, I expect 15 but they give only 10%, I am not happy about it. But when you are expecting 15 and company gives 15%, ideally what is the answer? You should be satisfied with it. You should not be complaining, neither you are not extra motivated, but you are happy about it because what you expected you have got it. So, you should be happy, at least I am okay, what I expected I got it, rather than being too greedy. So, you should be satisfied. So, same way here your NPV 0 means your project is earning what is expected by the investor. So, please understand, plus NPV, 0 NPV, both you generally accept the projects. Minus NPV, you reject the projects. Then when we are computing or calculating the NPV numbers, we all have to understand there are various cash flow we look at, So, it can be your revenue cash flows, your cost of sales cash flows, revenue cash flows, cost of sales cash flows. It can be various expenses cash flows, and you can have tax cash flows. So, there are various, even interest cash flows. So, these are some examples of cash flows. All these cash flows, generally when we calculate the project evaluation or investment appraisal, we assume even though the cash flow can be happening from day 1 to 365 days, day 1 to day 365 days, we assume the cash flow is happening at the end of the period. We don't want to take daily basis cash flows and discount daily basis. We take annual cash flows and discount annually. Unless the question wanted you to evaluate in a shorter period, it's generally annual evaluation, annual cash flow based evaluation. So all the cash flow whatever given is assumed to be incurred or earned at the end of the period. So generally, the end of the year only your cash flow is generated. That's how the assumption is. If you say that the cash flow, they say that the company is investing in the plant, whatever the amount, immediately. The words they use is immediately, or now, or the first day of the year. So you can see words like immediately, now, first day of the year, all these are year 0. Year 0. Today we are incurring that cash flow. So whatever the cash investment you are making today or immediately within a week or 10 days time, these all fall into now. Because there is no impact of time value of money for 10 days. Right? You don't have to worry too much about 10 days thing because it's a very small impact. So when you consider these all names, these all refer to year 0. That's the beginning of the year. So you are talking about day 1 of the year, day 1 of the year 1, day 1. So that is the year 0. All other revenue, cost of sales, expense, all these cash flows are generally assumed to take place at the end of the year. So that can be year 1, year 2, year 3, year 4, it can be any of these years, depends on the information available in the question. Sometimes the examiner or these questions can tell you beginning of second year. So when you are told beginning of second year, actually what is that year? End of first year. So please understand, beginning of second year is end of first year. So we need to know that some cash flows, the examiner could say the cash flows are incurred beginning of the second year. So if it is second year beginning, it is ideally end of first year. So you need to put into your cash flow statement, the column wise cash flow statement, beginning of second year cash flow, you put it under end of year 1. You don't worry about the calendar year, whether it is this year or next year. It's actually the time value of money consideration. We look at it, whether if you are saying second year beginning mean it's the end of first year. So you put the cash flow here. You cannot put the second year end cash flow. Second year beginning cash flow cannot be put into second year end cash flow. Okay. So that's basically some of the basic stuff. I'm sure you would have studied earlier also. But just brush up now. These have to be very clear. Where do you put your cash flow? If the examiner has not given you the information very clearly about the cash flow, it's always the end of the year cash flows. End of the year cash flows. There are, since we are talking about cash flows, depreciation if you have, you do not take. The profit and loss account will have non-cash item, mostly it's the depreciation. If you have that depreciation item, when you come to the cash flow statement for investment appraisal or NPV based calculation, you do not take the depreciation because it's not a cash outflow. So you just ignore the depreciation. The other thing is, there are certain expenses you may do irrespective of whether we are doing the project or not, those expenses are incurred. For example, if you do the feasibility study for which you have spent some money, so the money you have spent on the feasibility study is basically, it's a sunk cost, even if project is not undertaken, the cost what you have incurred is gone. So please understand the feasibility study or research and development cost, all these costs are incurred even though you may or may not continue with your project, these costs are incurred. Therefore, these costs are considered to be sunk cost. So please note that sunk costs will not be considered in your evaluation of projects. under NPV calculation, you do not take sunk cost as a cash outflow in your project appraisal. The other relevant costs, there are certain costs which are called relevant costs, which may be relevant when you are calculating NPV of a project. Those are like opportunity cost. Since we are involving in this project or product development or product manufacturing, you might sacrifice the contribution generated by some other products because everyone is involved here. Maybe sometimes you will see that the plant, this plant may be used in the past, it could be in the past you have been using and generating 10,000 a month income. Now you are going to take this plant to manufacture a new project or new products. So what you have foregone in the previous project or previous product, that becomes a relevant cost here. The contribution lost will become a cost here. That is one. Similarly, when you are going to use the human resources, the staff, those staff must have been generating some income or elsewhere. So when you use them here in this project, the income what they have been generating in the other projects, what it could be lost, that can be considered here. So please note that these are small things you need to consider part of the relevant cost calculation or maybe in the investment appraisal. That is also part of your cost. I think it's all covered in the study pack. So I'm just explaining the key things so that you should be very clear whenever you are using. Then other cash flow, generally you will have confusion is the working capital investment. In project appraisal, long-term project appraisals, the working capital investment, all the company, all the businesses need working capital investment. So generally what we do, we invest in year 0 working capital investment. And the money what you invest during the project will be recovered, say if the project period is 10 years, end of 10 year you get your recovery of the working capital. Investment. Whatever the amount you invested will be recovered end of the project period. It could be 10 years. If it is 10 years, 10 year end you will recover. But please be aware, if I say year 0, that immediately I invest 10 million in working capital. That I have invested for working capital. Year 1, the examination question or any question could be telling the working capital investment is increased by some amount. So example, you increase by 2 million in year 1. So the additional or incremental working capital investment is a cash outflow in year 1. Similarly, year 2, you want to, in order to sustain the sales or grow the sales, you will incur another working capital investment of 3 million. So please be aware, these are the incremental your working capital investment. So it's not the year 0 you invest working capital investment to support your sales growth in the company. Year on year, you need to increase your working capital because if your company is growing, you need to have more inventory, more data, more bank balances, all that. So then you do 10 million is not sufficient. If you open up new showroom, what do you need? You need to invest in your working capital. So 10 million may not be enough. So you have to increase your working capital by another 2 million, maybe another year, another 3 million. So what you are going to do, every year you may be increasing your working capital. So all these incremental working capital, there is a working capital total amount lying in your company while you are running the project. Entire investment you have made in working capital could be recovered only at the end of project period. So please be aware that amount of money you are going to recover at the end of the project period will be the total amount of investment you have made. If you are able to recover the entire amount, it will be taken as a recovery. Sometimes the examiner will say that only 75% of working capital investment can be recovered at the end of the project. Then only 75% only you can take it as recovered. So you should be clear in how much you take it for recovery. Okay. Then in terms of investment appraisal calculation, for tax purposes, you would be told how the tax rates are calculated, and one of the other adjustment you might think of is the capital allowance and depreciation. For the tax purposes, the depreciation whatever you are incurred will be added back and you will be claiming capital allowance. So the examination question or even other question, you will see that capital allowance percentage will be given. So you calculate capital allowance and you can claim it against your profits of the company. Depreciation what you are charged in your P&L will be added back and tax allowance, capital allowance will be claimed. So that's the tax adjustment you will do in your investment appraisal. So those are the few things you will have in investment appraisal. These are things you would have learned earlier also. How to evaluate your project feasibility by calculating the present value of the future cash flows. So when you are going to calculate, the cost of capital will be, generally the project cost of capital will be equals to expected return of the investors. Please be aware, expected return of investors is equal to cost of capital of the project, which is your discount factor or discount rate. Expected return of the investor, when I say the investors can be generally shareholders or debt holders or shareholders and debt holders. So the cost of capital can be, it could be shareholder return expectation or debt holders return expectation or combination of this. So depends on the money, depends on the source of finance you are using to invest in your project, the cost of capital can be different. But expected return of investors is equal to the cost of capital, which is what you use to discount your future cash flows to calculate NP of the project. Then in evaluating the investment appraisal, there is other factor which is inflation. How do you adjust your project cash flows for inflation? Inflation is something which reflects the price increases in the goods and services that you are consuming. So even any project you will be using products and services, right? Those products and services costs can escalate because we are evaluating the project in year 0, that is today, and we are talking about cash flows of the future, not the past. We talk about year 1, 2, 3, 4, sometimes some cash flows go into even infinite period. So your cash flows of the futures are for a long period. So these cash flows, even though we estimate the cash flows, there is always a possibility of inflation getting adjusted. So generally we have a assumption of what the inflation could be during this period. So we take that inflation percentage and adjust to the cash flow what we are forecasting. So please note, when we say the inflation is in the corporate world or the environment, the cash flows can be two types. Cash flows can be two types. One is real cash flows. This cash flow is without inflation adjustment. Without inflation adjustment. If you think there is no inflation in the world, what is the cash flow you will be incurring? That is real cash flow. The other cash flow is money cash flows or nominal cash flow. Money cash flows or nominal cash flow. This is after adjusting for inflation. After adjusting for inflation. So please note, there are two types of cash flows. One is inflation adjusted, other one is inflation non-adjusted. So without adjusting inflation, that is real cash flows. With the adjustment of inflation, money or nominal cash flow. So what you have in normally common situation, common if you take your own company wherever you are working, if you say you are talking about project investment or the investment appraisal, you will have money cash flow. Which means today when you go to buy goods and services in the market, those are money cash flows. No, there is no real cash flows there. Why? All the cash flows are subject to inflation. Therefore, these are the cash flows you would consider in evaluating your project. Unless the examiner tells you, please evaluate the question based on real cash flow, then you take the real cash flow. Otherwise, please convert, even if they give real cash flow, convert the real cash flows to money cash flow. Then the other thing, if the cash flows are, there are two types, your discounting rate or the cost of capital also have two. So what are cost of capital? You have two. One is money cost of capital, other one is real cost of capital. So if you are talking about real cash flows of the project, you please discount using real cost of capital. If you are having money cash flows, please discount using money cost of capital. So mostly what is very practically happening is you will have money cash flows and money cost of capital. So you evaluate the money cash flows with money cost of capital. And there is a formula to calculate money cost of capital, that is 1 plus M equals to 1 plus R 1 plus I. I stands for inflation, R stands for real cost of capital, M stands for money cost of capital. So if your question gives you real cost of capital and the inflation, generally this is general inflation, that is a common average inflation in the country. You take that inflation and real cost of capital and you calculate money cost of capital. When you get the money cost of capital, you would use that to discount money cash flows. So I repeat, your cash flows can be real or money. Cost of capital also can be real or money. So what we need to do when we are using real cash flow based evaluation, use real cash flow with real cost of capital. Money cash flows with money cost of capital. Money cash flow and money cost of capital is the more recommended, more practically used way of calculating. So real story may not happen in the market. The other thing is, you will see money cost of capital can be calculated by a formula. There are 1 plus R and 1 plus I, you multiply, then you get 1 plus M. This is called Fisher's formula. This can be used to calculate money cost of capital, which can be used to evaluate your project. So please be knowledgeable on the adjustment you may have to do when there is inflation in the project. So if they give real cash flow for the next 5 years, you need to calculate your money cash flows based on the inflation adjustment you have to do. Okay. So please look at study pack to understand how to calculate or multiply, divide, all that. Then we look at the other technique which is called IRR. Now we looked at ARR, payback period, those are non-DCF technique. Then we moved on to DCF techniques. Under DCF technique, first one we looked at NPV. Second we look at IRR. So IRR is the internal rate of return. Please note, internal rate of return is actually speaking, it's the project return. Whatever the project return you can generate is the internal rate of return of the project. So you may be thinking of how to calculate IRR, you have learned, I am sure. So you know how to calculate IRR, but actually IRR is the project return. So if you are going to evaluate a project, your company will be having expected return. Company will be having expected return, for example, 25% per annum. 25% per annum. And your project IRR is 22%. So will you accept or reject? You reject. Why? You are expecting the project to earn 25%, but your IRR is 22%. IRR is the return generated by the project, or that's your capacity of the project. Your capacity of the project is 22%, whereas your expected return is 25%. So you are not up to the mark based on your expectation, so you reject the project. So IRR is, you compare with the, IRR will be compared with the expected return of the investor. As I mentioned earlier, expected return is actually the cost of capital. The expected return of the investors is the cost of capital. Why? What is the expected return of the investors is the cost of capital of the project. So the project needs to earn this. So project expected return is 25%, which is the cost of capital. So if the cost of capital is 25% and your return of the project is 22%, will you accept or not accept? You will not accept. So please note, always a project to be acceptable, IRR should be always more than cost of capital or equal to the cost of capital. Your project should be, to be acceptable, the IRR has to be equal or more than cost of capital. If it is not equal or more than cost of capital, you are generating lesser return than the expected return. So if it is lesser than that, you cannot be accepting. So your investors are not going to be happy about it because you are earning less than what they want. So please note, this is the way of evaluating IRR. IRR is a formula based calculation. I am sure all of you all know, and it's in the study pack how to calculate the number. So it's not a big thing, you can calculate. But it's more than calculation. What you need to understand, IRR is the project return. Don't get lost in the number calculation. Understand what is IRR. IRR is the project return. That means the capacity of the project. Capacity means the capability of the project to earn how much. IRR is here 22%, that is the capacity. But the investor wants 25%. So if they want 25%, this is what the project is capable of, you cannot accept. You cannot accept. Why? You are not generating what they want. So in order to be project to be acceptable, always the IRR, the project return, should be more than or equal to cost of capital. Now when we look at NPV technique, what are pluses, what are minuses? NPV techniques, pluses and minuses. As we mentioned ARR and payback, we said that it doesn't look at cash flows, but NPV looks at cash flows. ARR technique and payback period, actually payback period looks at cash flow, but ARR doesn't look at, but NPV also looks at cash flow, so it's fine. And NPV technique looks at time value of money. Why? We discount the cash flow, so it looks at a time value of money. So it's advantage you have. Then NPV looks at total project cash flows, but your payback period looks at only up to the payback period. If it is 3 years payback period, only up to that cash flow is considered. But NPV looks at the entire project cash flow. So this is the advantage of the NPV technique. Minus. What are minus of NPV technique? Difficult to understand. If you are going to explain to a non-finance person, what do you mean by NPV? You are trying to say, okay, if I discount the cash flows, I get an NPV of so much, by which the wealth will be increasing, which is not easy to understand by most of the non-finance people. Same time, if you are going to go tell the same people IRR, where you say your project is going to earn 20% return. Very simple. Even though IRR may be difficult to calculate in a formula, when you say the IRR is 20% and it's the return of the project, people understand. And you ask the people how much you want it, they will say I want 18% return. How much a project is going to give you? 20%. So they are very happy about it. So it's easy to understand. So IRR technique, when you look at it, plus and minus, easy to understand. Whereas NPV technique, difficult to understand. Very important. It's not about calculating things. The people who are most of the time non-finance people, decision makers, will difficult to understand NPV. You may have very good way of calculating, you will be explaining everything, but still people difficult to understand. But IRR is to understand. They say, okay, this is your 20% return. Bank, if you put the money, how much you get? 5%. So that's the interest. And if you put in your debenture, how much you get? 9%. So that's your return. You invest in your project, how much you return? 20%. That's your IRR. So IRR is the return of the project. Very simple. So please note, easy to understand is IRR, not NPV. The other thing, NPV technique, when you look at it, most of the time NPV technique assumes that the cash flows are fixed. When you forecast the cash flows, those cash flows are going to be fixed. It can be changed. So therefore, that NPV technique has its own limitation where the cash flows can really vary, but we assume that cash flow don't change. So there is a minus for NPV technique. IRR technique, the other problem with the IRR technique, or the problem with the IRR technique, if you have two projects, different sizes, say A project, B project, you will see the investment 100 million, 10 million, 100 million, 10 million, and assume that NPV of the project is 10 million and 1 million. IRR say 18%, 18%. If you are going to compare the IRR and decide which project to be taken, A and B both are same. They both gives you same return. Whereas if you look at the NPV of the projects of A and B, one is 10 times bigger than the other project. So obviously you should select A project because that creates more wealth than B project. But IRR technique will give you number 18, 18. So when you look at purely the 18, 18, you will see both are fine, both are equal. So you will select one of that. But ideally speaking, you should be selecting A project, not a B. Why? That will give you more value creation than the B. So therefore please understand, IRR technique, size of project not considered. Size of the project not considered. That's the disadvantage of IRR. Second, if you have non-conventional cash flows, you will have multiple IRR. You will have multiple IRR. What do you mean by non-conventional cash flow? The cash flows are conventional, where you see year 0, 10 million minus, year 1, 2, 3, you have positive cash flow. If you have minus cash flow and positive cash flow continuing, this is called conventional. Traditionally, this is how. Generally, you invest at the beginning, after that you generate cash flows. You invest at the beginning, you generate cash flows subsequently. This isn't conventional. Normally what happens? Non-conventional is, you will have minus at the beginning, then you get positive cash flow, again you will have minus, again positive cash flow. So it's a combination of plus minuses. If you have kind of cash flows like this, these are called non-conventional cash flow. When we have non-conventional cash flow projects, you have multiple IRR you will get, which means you cannot make a decision properly. You will have IRRs for the same project, 20% of the IRR, 35% of the IRR. So which one you are going to take? You cannot say accept or reject because you are confused. So please note, non-conventional cash flow if you have in your project, please don't use IRR technique to evaluate the project, because it will give multiple IRR which is wrong which is confusing. So size of the project not considered, non-conventional cash flow, multiple IRR. Then one of the other thing in the IRR, the problem is, if you are having a mutually exclusive project, IRR should not be considered. Mutually exclusive means when you take this project, other project cannot be taken. So your mutually exclusive project, IRR should not be used for technique. So these are some of the plus minus of the NPV and IRR. Even though each technique has its own pluses and minuses, right? Even IRR technique, the plus is cash flow, time value of money considered, like your NPV, it also uses cash flow and time value of money is considered. But it has its minuses. So please be aware, it's in the TUT or the study pack also, so you can look at it properly, the wordings and stuff. The IRR technique and NPV technique both are discounted cash flow techniques, but NPV technique is more superior than IRR technique. NPV technique is superior than IRR technique. Why? Why NPV technique is superior than IRR? The main reason being the reinvestment assumption. reinvestment assumption. What is reinvestment assumption? Whether it's NPV technique or IRR technique, both has this reinvestment assumption. What is reinvestment assumption? Both or the cash flows of the project, any project you take, the cash flow of the project could be excess or shortage. Any year of the project period, you say 10-year project period, during the 10-year period, you will see some years you will have excess cash flow. That means you have excess cash flow. After you revenue cash flow will come to your, and you spend for expenses and you have net cash flow, which is excess cash flow. You might have 5 million excess for a year. Next year, it can be 10 million excess. Another year, you will have shortage of cash flow. So what do? A rational investor will, if you have excess cash flow, he will be reinvesting. Excess cash flow, reinvestment. You do the reinvestment. Shortage of cash flows, you will be borrowed. When you say that your company will be short of cash flow, you will borrow. This is not a scientific thing. It's basically a normal thing, even normal life, every one of us. When you have excess money in our hand, what do? You invest. Not a reinvestment, invest. You will invest. When you have shortage, where you need money next month, suddenly 100,000 rupees, what do? You borrow from somewhere. You borrow from somewhere. Even at least you use the credit card, that is all borrowing. So whether you are borrowing or investment, both can be done or both will happen in a project, during the project period. So the NPV technique assumes this investment or borrowing, which can happen during the project period, will be done, investment and borrowing will be done at cost of capital of the project. In other words, when we have excess cash flow in the project, the excess cash flow will be invested in the market environment or investment opportunity at the rate of cost of capital. Similarly, if I want to borrow money because I am short of cash, I will be borrowing at cost of capital. So my investment and borrowing both will be done at cost of capital. Whereas in the IRR, the reinvestment assumption, that is investment or borrowing, will be assuming to be done at IRR. What you need to understand here, cost of capital is a rate which can be available in the market. You can go to the bank and find out what is the rate which could be equal to cost of capital or at least closer to cost of capital. IRR is the return of the project. The return of the project is not something available in the market. It is your project which is giving you a return of so much. So your excess money and shortage of money, you cannot assume that you can reinvest or borrow at the IRR. Why? It's not in the market. It's not available, readily available in the market. So it's only in your project you can get, not in anywhere else. So therefore this is the assumption of IRR technique, where your excess money will be invested, shortage of money will be borrowed at the IRR rate, where an NPV technique assumes it's at the cost of capital. So therefore, we need to be clear, cost of capital assumption, IRR assumption, which is more realistic. This is not in the market. So therefore, it's not realistic. Your assumption is not realistic, but this is realistic. So therefore, the cost of capital is realistic, IRR is non-realistic. That is why we said NPV technique is superior than IRR technique. Superior than IRR technique. Okay, keep that in mind. Due to the limitation or the weakness, key weakness of the IRR technique, due to the key weakness of the IRR technique of this reinvestment assumption, only the modified IRR was brought in or developed. Modified IRR. So what the modified IRR does? Same IRR computation is done on the assumption that your reinvestment of or excess of money will be done at your cost of capital. So the assumption of reinvestment assumption is that it's done at the reinvestments are done at the IRR, but under modified IRR that excess cash flows or shortage of money will be borrowed at the rate of cost of capital. So that is MIRR. So you calculate the MIRR, that basically on the assumption that your excess cash flow will be reinvested or shortage of cash flow will be borrowed at the cost of capital. And you calculate the MIRR and see how much you are getting. So that will give you a reasonable IRR or MIRR, which will be based on a reasonable assumption. Okay, so keep that in mind. I think it's an example in the page number 162. 162, you can look at the modified IRR exam. Very simple example is given there, so you can understand how it's calculated. Then, so these are the few of the techniques, and there is another one technique is a discounted payback period. Discounted payback period. The payback period is generally how long it takes to recover your cash, but discounted payback period where you calculate the same calculation but only taking the time value of money consideration, that is discounted cash flow. So you will say take how long the project will take to recover your investment in terms of time value of money. So you take your present values. So you say year 0 you invest 100 million, year 1, year 2, year 3 like that, you say 40 million, 50 million and 30 million. So these are in present value terms. And say how long it takes to recover your investment. Earlier payback period we look at all our cash flows, but in the discounted payback period is all you convert the cash flow into present value and see how long it takes to recover your investment from the future cash flows present value. So these present value cash flows, present value of the cash flows, how long it takes to recover the investment. This is the discounted payback period calculation. So this is also another technique under discounted cash flows where you can calculate to evaluate the project appraisal. Then the project appraisal, one of the other thing you may look at is the risk or uncertainty. Risk or uncertainty. So any project when you take or going to invest is subject to this, because the future is uncertain. There are various risks can take place in the company or the project. Risk means anything which is going to disturb your objectives being achieved. So there are a lot of things will come in the market environment over the period which will disturb your objective being achieved. So you want to achieve 1 million turnover, you want to maintain your cost of sales at 20%, or you want to ensure that the expenses of or admin and selling expenses are going to be so much percentage, and you want to incur a cost of capital or the interest cost of 10%. These are all assumptions you are making. But these all can change. Why? There are various risks. The market can change. So if these are going to change, my evaluated project today can become unsuccessful during the future. So today I calculate the numbers and say my NPV is 20 million plus and accept the project. But 1 year later, due to these changes happening in the market, I will see that project is unsuccessful. So then what do I do? At the beginning, that is in year 0, now while we evaluating the project on a normal basis, we calculate various other information that will support to consider risk and uncertainty of the project at year 0. Now itself I do this calculation. So there are various techniques you could be using to calculate the or bring the sensitivity into the risk into the whole thing. There is one is sensitivity analysis. So what do you do in sensitivity analysis? We calculate each and every variable in relation to the project, which can be selling price, variable cost, fixed cost, your scrap value, you might quantity or the volume. All these items you find out the sensitivity of those variables to the NPV. So, for example, you say your selling price. You are estimating your selling price to be 10 rupees. And you calculate your future cash flows and evaluate your project. And your NPV of the project can be, say, 10 million plus. There are various cash flows you have taken and your selling price is 10 rupee. You take the selling price at 10 rupee and you get an NPV of 10 million. But over the project period, your selling price 10 rupee can drop. Why? Maybe due to the competitor action. Competitors are reducing prices and you also have to reduce them. Otherwise you can't survive in the market. So what do? You also reduce it. So when you go to reduce the selling price, your future cash flow will change, your NPV will change. So you don't do that during the project period, third year, and say the management or board, come on, I can't now run the company or the project because selling price has come down, my project is going to be feasible, not feasible. You can't do that at that time. So what do you do now? Year 0, you calculate what is the sensitivity of your selling price. So you calculate the sensitivity and find out if the selling price changes, for example, 20% minus, say 8 rupees. If the selling price come down by 20% in the project period to say 8 rupees, what will be my NPV? So if my NPV I calculate and say minus 2 million, then I know that 20% drop can result in 2 million minus. So each variable I need to calculate sensitivity and find out which variable is more sensitive. Which variable is more sensitive. So after doing this sensitivity calculation, I need to call for a meeting with my heads of the division. I will bring the production man, I will bring the marketing man, and I will bring the finance person, and everybody will come. So all these people I will discuss and say, okay, tell me now, what is your gut feel that your selling prices will not be brought down by X amount? What is your chance of your variable cost being maintained at this level or with a 5% growth or 5% increase? So you need to discuss, serious discussion with your team members and make sure that your variables, what is your level of change or what is the maximum change you will be expecting based on your experience. After that, you decide whether I should accept this project or not accept this project. Not simply calculating NPV at the first shot and see NPV positive, accept the project. No. We have to do this risk analysis where we need to do sensitivity. Then after considering sensitivity, there are variables which are more critical and there are some variables not critical. Critical means slighter change in that variable, you will result in NPV being negative. Slighter change. 1% change in selling price can result in NPV negative. Then it's so much critical. So I may not take the project forward because I think okay, 1% change is very, very sensitive. Better I don't touch it. So you have to be very careful. When you do sensitivity, it gives you the knowledge of how much each and every variable is sensitive to the project. Based on your understanding with the team members, you decide whether to accept a project or reject a project. So it's not just calculating NPV of the project and say accept or reject. You need to do the other risk analysis. One of the ways is the sensitivity analysis. So please be aware. There are situations where to bring the risk into the whole equation, you might adjust your cost of capital. Cost of capital. In order to evaluate the project, you say for example your cost of capital is say 15%. In order to consider risk aspects of the project, you say okay, I need 2% more than your cost of capital, say which is 17%. So I will evaluate my project using 17% discounting rate. So this is my risk premium. I would like to have more risk premium of 2% to the cost of capital, so my expected return becomes 17%. I take the 17% as my cost of capital and evaluate my project and see whether acceptable or not acceptable. So this is another way of doing the evaluation to accept or not the project. Maybe another one is called certainty equivalence. Certainty equivalence. So you convert your cash flows to certainty equivalence. If you have a 10 million cash flow in year 1, you will sit and discuss with your team and see the 10 million to what extent we can get it. So people might say, okay, 10 million may not be possible, say 80% of your cash flow can be generated. So you convert your normally forecasted cash flow to certainty equivalence and calculate the NPV of the project again. So these are various techniques you could be using to bring the risk into the evaluation. That you are doing in year 0. Please be aware that you are not doing in end of the year project, you are doing at the beginning of the project. Before accepting project, your sensitivity, your risk adjustment to your cost of capital or your certainty equivalence, various techniques can be applied and adjusted and calculate your NPV to accept or not. So on continuing on the investor appraisals, we look at the point on post-completion audits. Post-completion audits. This is actually a process. This is a process you would do when you complete the project. What I would like to say is that you may have a 5-year project or even 10-year project. When you complete the project, you would like to go through the whole project aspects. It could be time period, how long it took taken, how much cost had been incurred, what are the excesses we have spent, and what are issues we faced. All that you would be doing under post-completion audit. What is the purpose of doing this? Main purpose is to find out what went well, what went wrong. So you as a team have to go through this process to find out what went well, what went wrong. Because when you see what went wrong, you would be able to use that knowledge to correct the future projects. Especially these are not small amount projects, these are million rupee projects. So you cannot be taking for granted. You need to be very careful in evaluating any projects. But if you have evaluated and go on with the project and which sometimes end up with a failure. So how do I correct it? So the project what you have gone through already finished, you may not be able to do anything. But at least from now onwards, any new project you are going to take, you need to be very careful. The post-completion audit the purpose is that to correct the future projects based on the past experiences. The other aspect is, rather than you waiting till the end of the project, you may decide to do the evaluation before the project ends. So if it is a 10-year project, we may decide, okay, we don't need to decide or wait for 10 years, we can do it in 5 years. So ideally 5 years time or 3 years time, you reevaluate the project, how is the implementation, and find out where do you stand. By that time, sometimes you might realize that some of the costs what you have forecasted are wrong. Your revenue forecast had been wrong, or you have not talked about or you have not looked at certain risk in the project, and you never forecasted what are the other possible things can happen. So these are the learning. When you do this post-completion audit, you will realize. So please be aware that these are one of the important tasks in the capital budgeting process, especially because the amounts involved are millions or sometimes billions. You need to do this post-completion audit on a regular basis. Even if you don't do, most of the time what happens is the end of the project people do it. So when you do end of the project, the objective of the due process is to find out the mistakes what you have gone through or what you have made over the project period and correct it for the next project. So this is one of the important process. Then there are certain other things you would like to learn. This is capital rationing. Capital rationing is limitation of your capital. Limitation of capital of the company. You might see that there are projects X, Y, Z. Initial investment, say 100 million, 120 million, and 40 million. It can be any amount. And you will see that NPV, say 100 million give you 10 million NPV, Y project give you 12 million NPV, I am just a simple example, 14 million NPV. Now if I ask the question, out of this, which project or projects you will be selecting? So you will see that, okay, there are 3 projects, I get 14 million NPV from Z project, that's the highest NPV I can generate, so better I take the Z project. So immediate answer, people might think, okay, Z project is the ideal answer. The answer is wrong. Why? What is your primary objective of the corporate or primary of the company? Maximize the shareholder wealth. So if you want to achieve maximizing the shareholder wealth, what you have to do? You need to select all the projects which give you positive NPV. If your objective is maximizing shareholder wealth, any project which gives you positive NPV, please accept all the projects. Please accept all the projects. If you have a project called D, where you need 100 million investment and you get 2 million NPV negative. If your objective is to, primary objective is to capitalize or maximize the shareholder wealth, Z project you will not select. Why? It destroys value. That's understood. But other than that, all the 3 projects which are giving positive NPV, you have to select. Why? All are giving creating value. Creating value. So please note, whenever we are given many projects to be considered for evaluation, we can select all the projects which gives you positive NPV. Then you may have a question, can I accept all my projects? Yes, you can accept, provided you have no limitation of any resources. If you have enough resources, you can invest in any project which gives you positive NPV. So key principle is, if you know limitation having resources, you don't have any resources limitation, any project gives you positive NPV, you can accept. If you have limitation of resources, then you have to decide which project is the best project. The capital rationing is an area where you have a limitation of capital. So if you don't have limitation of capital, accept all the projects with positive NPV. But when you have a limitation of capital, what do? So the capital rationing is a concept or situation or status where your company have limitation of capital. So when you have limitation of capital, you cannot accept all the project. You cannot accept all the project. So you decide the project which gives you the maximum output from the similar amount of investment. So you invest same amount, but your output is more than other party, other project. So you select that project. So it's like an input-output ratio, your productivity, where which one will give you more productivity, that one you will select. So limitation of capital is there, you need to decide, for example, say XYZ 3 project we are talking, you say your initial investment say initial investment is 10 million and here 15 million, here 20 million. And your present value of future cash flows, you will see that this give you 12 million, this will give you 20 million, this give you 35 million. So then what you do, you need to decide for the 10 million investment, I am getting 12 million future cash flows present value. So it is actually 1.2 times, 1.2 times. 15 into 20, it's 1.33 times. 20, it's 1.15 is 1.75. So you will decide, okay, for 1 rupee of investment, I get 1 rupee and 75 cents return. 1 rupee investment, here I get 1.33, here 1.2. So I will select the one which gives me more recovery of my investment for 1 rupee investment. So that is the Z project. So it's your input-output ratio, productivity point of view, which one gives you more output for the same amount of investment. For 1 rupee investment, this project gives me more recovery than the other two projects. So I will select this because if I have a capital limitation, I cannot invest in all 3 projects. I will decide the one which gives the highest recovery. So this is the capital rationing situation. How do you evaluate? The capital rationing situation can be soft capital rationing, hard capital rationing. This is a theoretical differentiation, soft capital rationing and hard capital rationing. Soft capital mean it's more relevant to your management related decision making limitations. Hard is related to the market environment. If the banks are not willing to give you loans for your capital need, then it's hard capital rationing. You are faced with that problem. Your management internally decide we should not go to borrowing. Then it's a soft capital rationing. Your management is deciding or limiting your capital raising. That is soft rationing. So please understand that's in the TUT or the study pack, right, which basically differentiate these two. In terms of projects to be selected based on capital rationing, you would realize that when you look at the study pack, you need to decide whether the projects are divisible and non-divisible. Projects are divisible and non-divisible. What do you mean by divisible and non-divisible? Projects can be divisible and non-divisible. Divisible, non-divisible. What is non-divisible, divisible? Say you have to invest 10 million, this is your investment. And your NPV from the project is 3 million, positive. 10 million if you invest, 3 million NPV. And you have capital of 5 million, capital of 5 million. So if I say the investment you invest 5 million, your NPV you can generate 1.5 million. So if you invest 10 million, you get NPV of 3 million. If I invest 5 million, I get NPV of 1.5 million. If I can break my project by some amount, similar amount of NPV, that is the proportionately I can get my NPV, then that project is divisible. Do you understand? I am investing 10 million in a project, that project can give me 3 million NPV. Instead of 10 million, if I invest 5 million, same project can give me 1.5 million NPV. It's like a plant. 10,000 units producing plant I can buy, or I can buy a lesser capacity plant which can produce 5,000 units. So if I can do that and I can still get proportionate NPV for my investment accordingly, then I better go with divisible nature. That's a divisible nature projects. So when the projects are divisible, when you have capital rationing, when you are having capital rationing, profitability index approach can be used. Profitability index approach. So we will use the profitability index approach to evaluate the best projects or selecting the project. We will use the profitability index approach and see the project which gives the highest output for my investment and select those projects. Only condition, the project profitability index to be used, projects should be divisible. If the projects are not divisible, this technique cannot be used. This cannot be used. So please go through the study pack. You will realize that if it is divisible, you can use profitability index. If you can't divide the project into piecemeal or the small amounts, you have 10 million money, you can get so much, you have only 5 million. So you are not going to invest 100%, you are going to invest 50%. If I am going to invest 50%, you can only get this much if the projects are divisible. If the projects are not divisible, you cannot invest 5 million and get this NPV because it's out, this question is out. So profitability index approach can be used if the projects are divisible. If the projects are not divisible, this cannot be used. Only way is NPV technique, and you identify what are the projects I should invest to create wealth for me. Okay, so go through the TUT, you will understand that. Then one of the other thing you would like to learn in the investment appraisal is the international investment appraisal. International investment appraisal. Actually, my next session will be on foreign currency management. We will discuss the foreign currency management next session. So when you learn that, you will realize that the company in Sri Lanka could be investing in foreign country. Those are international your projects. So how do you evaluate the international investment? International investments, when we are investing, there are two ways of evaluation, or two ways you can do the evaluation. One is you will forecast cash flows of the foreign project or international project. Forecast cash flows of foreign project. And you will discount these cash flows, discount these foreign cash flows by foreign country required rate of return. So if I say I am investing in Maldives, I will be calculating the Maldives what is the required rate of return for a similar project. So if I am putting a resort in Maldives, the return what I require in Maldives to invest in Maldives, I take that as a cost of capital and discount the Maldives cash flows. And I calculate the NPV. I calculate the NPV in Maldives. So our answer what I get in NPV is Maldivian rupiah. That NPV I convert to Sri Lankan rupees at year 0 spot rate. So please note, you forecast the cash flows of foreign project. That is in Maldives, you say 10-year project you are talking about. 10-year future cash flow you forecast in Maldivian rupiah. Those 10-year cash flows, this is your first step. Those cash flows you discount. Discount by what rate? Required rate of return in foreign country. If you are in Maldives, what is the return requirement of anybody who is investing in that resort? You use that required rate of return and calculate NPV. So that's your third step, NPV. Once you get the NPV, which is in Maldivian rupiah, foreign currency, that NPV you convert to Sri Lankan rupees at year 0. You convert to Sri Lankan rupee at year 0 the spot rate. That is, spot rate means today's exchange rate. Sri Lankan rupee and Maldivian rupiah, what is the rate today? You convert the Sri Lankan foreign currency cash flows to Sri Lankan rupee and get the present value of the cash flow in Sri Lankan rupee. This is one approach. Please note, this is your forecasting foreign cash flows of the project. Discount using foreign required rate of return. Investor in foreign, whoever would be looking at the project, how much they expect, you discount that rate. And get the NPV in foreign currency. The NPV is always year 0. That NPV you convert at the today's spot rate and convert the rupees to, you get NPV in rupee term. This is one approach. Second approach will be you will forecast foreign currency cash flows. You forecast the foreign currency cash flow of the project, it's an international project, you have foreign currency cash flows. Second step, convert to Sri Lankan rupees. So you start from year 0, say if it is year 10 project, all these years your forecasted cash flows you convert to Sri Lankan rupees using the exchange rate, predicted or estimated exchange rate. you will convert to Sri Lanka rupees, year 0 to year 10 estimated exchange rate. Once you convert to Sri Lanka rupees, the cash flows, you discount at required rate of return of the investor, in Sri Lanka. In other cost of capital in Sri Lanka. So if the Sri Lankan company is investing in Maldives, what is the cost of capital in Sri Lanka to invest in Maldives? You use that cost of capital to discount the cash flow what you have got in Sri Lankan rupees. Fourth one, you get your NPV. This is the second approach. In both approach, you need to forecast foreign currency cash flows. It can be year 0 to year 10 if the 10-year project, year 0 to 10. Those 10-year cash flows you have to forecast in foreign currency. You convert that to Sri Lankan rupee using estimated exchange rate. Year 1 to 10 you should know the exchange rate, forecasted rate. Convert the cash flows into Sri Lankan rupee. Then you have got the Sri Lankan rupee cash flow for year 0 to 10. After you got that cash flows, you discount using required rate of return of investors in Sri Lanka. So that's a Sri Lankan company cost of capital. So what are the cost of capital of Sri Lankan company? What is the expected return of them? Take that as a cost of capital, discount this cash flow. Then you get your NP. So this is what you do in the other second approach. So international investment appraisals you can do two ways. One is what we discussed earlier, second is this. Okay. Please note, whenever we talk about foreign investments or international investments, there are various risks in international investments. Apart from normal local environmental risk, international investments have various types of risk. So what are the risks you will have in international investments? One, you will see the political risk. The foreign investments, when you are going to invest in say Maldives or any other country, that country is subject to that political risk of the country. So suddenly after you invest in 1 year's time, the government changes in the country, your rules of the game changes. So the another important risk is the political risk. Second, you will see that exchange rate risk. As I mentioned, maybe next section we are discussing the exchange rate risk. That is your foreign currency and Sri Lanka rupee, there is exchange rate. That exchange rate can vary in the future. So when it varies, you have the risk of your cash flow being changed or varying. So that's the second important risk in a foreign currency or foreign international projects. Third, the regulations or compliance risk. Most of the time the foreign projects, the regulations are very strict and you have to be very much knowledgeable about the foreign currency rules and regulation. You can't just, like what you do in your own country, you cannot go and just invest in that country, because you should be very clear about the knowledge or the laws of the country. If you violate the rules of the game or the rules of the country, you are penalized or your compliance risk is very, very high. You are going to incur a lot of money, so you have to know the regulations and compliance. Then you will see your market risk, which is common even in Sri Lanka or any other country, your demand related, whether you have sufficient demand for your products and services. So market risk has to be looked at properly. If you are going to borrow money, you will have to look at the interest rate risk. Then you might see the technological risk, because there certain times some of the projects you may be using the high-tech machineries. So the technology risk is that 3 years down the road, the technology changes so much, your plant that you have bought is not capable of producing the goods demanded by the market. So it's so fast, the technology changes, your plant, what you have invested already, may not be able to produce the goods what is required in the market. So this kind of thing will result in your project being failure. So you need to know that this is another risk you have to look at. So these are a few of the risks. You may have to be very careful when you are going to go for a foreign project. See whether these kind of things can be managed with your expertise. If you are doubtful, you may have to get into a joint venture in that country and do the same business. Because there are various ways you can start business in a foreign country. One, you create a subsidiary company in that country and do a business. Or you might buy the company in that country and run the company. Or you create a joint venture. So there is a three options you can think of. One is you invest totally and subsidiary, you put it 100%. Or you will go and buy the company which is locally running in that country. Or you go for joint venture where you get a local player also part of the ownership, so that you are reducing some of the risks that we talked about here. Right, because they are the local knowledge who could help you to understand the business in the country. So they will safeguard you sometimes. But sometimes that also can be a problem for you. So please be aware that these are the risks you may have to know before going into a foreign investments. It's not just getting Excel sheet, worksheet and calculate the numbers and say NPV positive, go and invest. No. These are qualitative information you have to analyze. You have to send a team of people to see that market, environment and do a study about the legal compliances and ensure that you are very clear about it. You cannot, some country you cannot start by just opening tomorrow morning, you can't close it day after tomorrow. You can't do that. And your employees, once you recruit, you cannot ask them to leave immediately. If you do that, you have to pay a large amount of compensation. So these are the rules of those countries. And taxation. There are taxation in the country, suddenly the taxation can change. If the taxation changes, your feasibility of the project can be a failure. So you need to be very clear and careful whenever we are going for international investments. It has to be taken additional care than you doing a project in Sri Lanka. So these are some of the things you need to look at in international investments. So when we see this investment appraisal as an area, even though these are concepts you have learned in previous stages, from the final level, that is corporate finance and risk management area, you need to be knowing this thoroughly. One, thoroughly you should be aware of these techniques, and we need to be very clear in what we are doing. Because previous stages, when you do this evaluation of project, your cost of capital means you need a discounting rate. You just take a discounting rate and discount. But now with the final level, when you learn cost of capital chapter, capital structure chapter, various other things, you are very knowledgeable now on what is cost of capital. What is relevant cost of capital for this project. So you have to take the respective or related cost of capital to discount your project appraisal. The other thing, your cash flows have to be very clear into your mind how to estimate your future cash flow. And what are the cash flows you should take? Inflation is there, how do I adjust my cash flows? And what is the relevant cost of capital I should use? So these are things you have to be very careful in project appraisal. Generally, this is not like in your initial stages where they will be giving you just a project appraisal and say evaluate the project. It may be part of your case study. They will give one portion of the question where you may have to evaluate your project using the cash flows. So please go through the study pack, all the areas relevant to this, and those are good examples are there. You can look at to find out the numbers side and be very much confident about the area. Even though it looks sometimes you have learned it already, it might as well go through it again, refresh your mind and see whether any area where you are not clear, so that you are mastering the area. Okay, thank you.